This channel is for educational purposes only. You and you alone are responsible for your investment decisions.
Today I want to talk about market timing and dollar cost averaging.
Market timing is an investment strategy where investors try to predict the future direction of financial markets, such as stocks, bonds, etc., and they try to buy those assets at more opportune times. The goal is to buy when prices are low and sell when prices are high, thereby trying to maximize their profits. The issue is market timing can be very challenging. You got to be able to predict the future. Those short-term movements are extremely difficult. It requires not only a deep understanding of market trends, but the ability to anticipate economic and geopolitical events. Another thing to consider is if you're trying to time the market, typically you're going to have more trades, which could result in more taxes. That's why getting the pros on your side, accountants, financial planners, is to your advantage.
Now, having said all that, I bought one share at Nvidia yesterday and tried to time the market before earnings.
Nvidia has had a massive run this year, going up 240%.
Nvidia is also trading at a ridiculously high PE of 89, which means you're paying a lot more for the stock. A lot of the professionals will argue it's just too expensive.
Think about the profound changes over the last 100 years, from the introduction of the TV, radio, cell phones, air travel, the internet, the mapping of DNA. Companies at the forefront of innovation have the potential for high growth and profitability. Nvidia is having their iPhone moment, as the CEO stated in a previous conference call.
Now, trying to time the market's near impossible, and Nvidia could have easily gone down $100 a share today.
Instead, I try to look at the bigger picture and ask myself the following questions. If they tick most of these boxes, then I consider that asset as a potential longer-term hold. I wish I could have purchased more, but I'm starting literally from zero for my investor challenge to get up to $1 million. So I only made enough on Uber last week to pay for one share. Nvidia earnings were out earlier today, and they did crush it on every level. So this time I got lucky. It's up after hours. Dollar cost averaging is an investment strategy where the investor divides up the total amount to be invested across periodic purchases. So with dollar cost averaging, essentially what you're doing, instead of buying everything at the same time, you say buy a share once a week or once a month. The goal of dollar cost averaging is to reduce the impact of volatility on an overall investment and potentially lower the average cost per share over time.
Dollar cost averaging is a strategy I use all the time to reduce my overall cost within a stock. It reduces my risk and allows me to accumulate shares over time in quality companies that I believe in.
It is possible to have a hands-off approach with dollar cost averaging where you set it up with your employer into, say, a retirement account or even with your online broker. I had intended this video to be my first options trade for my $1 million challenge. However, the market changes daily, and when Nvidia, a quality company, goes down 8 to 9% on really no news, I have to take advantage of that.